Let's turn now to how officials in Washington and business leaders are reacting to President Donald Trump's sweeping tariff policies. We've got Dionne Jr. He is a senior fellow in governance studies at Brookings. We also have Linda Yueh, London Business School adjunct professor of economics. Thank you both for being here this morning. I want to start on this note we have from Bank of America, Michael Hartnett, saying that these inflationary pressures that we are seeing in the market right now will potentially handcuff the president's ability to go as far as he might want on tariffs. Do you agree with that?
Well, first of all, happy Valentine's Day to everybody out there. I think that the problem we have with judging what Trump is doing is that we don't know how what he says at a given moment is going to match what he ends up doing. And the market seems to have decided they're going to wait to see what he actually does. We saw with Canada and Mexico that he threatened these huge tariffs on a Friday, and by a Tuesday they were postponed. So first thing is we don't know where this ends up. But secondly, I agree with the danger that's being described there. These would be, Anna Swanson had a very good analysis in the New York Times that suggested these are the most sweeping. These reciprocal tariffs go way beyond anything Trump has proposed. They could blow up the whole world trading system. I don't think she suggested that. I don't think that's going too far. If he did everything he kind of threatened to do in that, we would be in a very new world when it came to trade. Tariffs obviously increase inflation to some degree. If we're lucky, we're saved by a change in the value of the dollar. Not all prices go up equally. But this is a big tax on what people buy, and that's a real problem for the broader economy.
And Linda, I want to go to you here because it's also a problem for companies. Talk to me about how you are thinking through the impact for earnings and therefore the impact to the market moving forward.
Yeah, it's absolutely a big issue for companies because this tax is being imposed on their final good as they sell it into the U.S. market. So this is essentially an increase in production costs. And I think what's uncertain, and I think what you've just been discussing, is when it's going to fall and where it's going to fall. So for a lot of companies, if they're thinking, well, I've put my supply chain through, say, Mexico or Vietnam, which are ways of moving production out of China, those two countries have, they're in the top 5 in terms of trading surpluses with the United States. So if you're going to look for countries which run trade surpluses and goods, then I think it's going to raise challenges around how companies will organize their production, having already done so, spent money doing so, to move away perhaps from a connector country. So that's certainly one issue. But I suppose the overall issue, the problem for companies, is just that it adds uncertainty, and uncertainty deters action. Companies may hold off.
Yeah, Linda, I want to stick with you on that uncertainty because I wonder how you are trying to get clarity on what differentiates between tariffs that could cause a one-time price hike versus tariffs that could cause more significant and sticky inflation.
So reconstituting supply chains would actually be a longer-term uncertainty. So if we think that the U.S. in general just doesn't like unfair trade, and having a trade surplus is a proxy for that, then I think that could cause, higher costs for trade for several years. Now, if it's a tariff that's coming in because the U.S. wants to invite countries to negotiate, and it doesn't affect supply chains, so it's not targeting trade surplus countries, then I think it would be less sticky. But let me just say, reciprocal tariffs on countries that impose tariffs themselves, I think the Trump administration believes that value-added tax, so VAT or VAT, is an example of other countries taxing, being unfair in terms of trading with the U.S. That covers 175 countries in the world when you also include goods and sales tax. So that's nearly everybody. And that's almost unprecedented in terms of thinking about imposing tariffs by any country.
Yeah, it certainly is. And it also sounds like sticky inflation. So EJ, let me go to you. You have a line in your latest piece in the Washington Post. You say Trump has a, quote, obvious indifference to rising costs. He was elected by constituents who wanted inflation to come down. How are you squaring the difference between what his policies are indicating and what constituents elected him for?
I think that is going to become a bigger and bigger problem down the road if inflation stays where it is or goes up. We're seeing in certain spheres the price of eggs going way up, for example. And I think in his campaign, he said over and over, I will bring prices down on day one. A lot of the swing voters, not his base who would be with him in any circumstance, but the people who actually elected him by moving his way, were people who were worried about immigration. And we can argue, and I have deep problems with the way he's doing this, but that was one issue. But prices were his major attack line on Biden, on Joe Biden and Kamala Harris. And if inflation goes up, I think this will obviously give a political opportunity for Democrats to say all this crazy stuff you're doing with DOGE, all these tariffs are not doing anything about the problem on which you got elected. And so I do think this catches up with him politically, maybe not tomorrow morning, maybe not next month, but certainly by the time we have midterm elections in 2026. And so I think that is a big problem for him.
All right. EJ Dionne Jr., thank you so much for joining us. And Linda Yueh, thank you for joining us as well. We appreciate you.